Hi, I'm Austin Gehring with Ag360 Grain Marketing. In this week's podcast, we will look at recent price recap, market IQ confidence gauges, comparable report day prices in the past, and mention our managed futures service, which can be an alternative to your retirement investment. Today is Tuesday, April 8, 2025. Here's today's market IQ report. Big headline items over the past couple of weeks. Tuesday, March 31, we saw the planning intentions and quarterly stocks report from the USDA, which gave us numbers mostly as expected, as corn and soybeans were only slightly lower. Then Wednesday, April 2 came around. Trump announced a long list of tariffs taking effect on countries, with Canada and Mexico excluded for the time being. Friday, April 4, we saw follow-through selling as China announced retaliatory tariffs, with soybeans leading the way lower. Monday, April 7, we saw rumors circulating of a 90-day pause on the tariffs, which got the market excited, but ultimately those rumors were squashed. Today we got back to trading a little more weather, but still saw tough sledding. Here's some current and upcoming dates and headlines to watch out for. Tariff headlines are obviously the primary item we trade. On quieter days, we can pay some attention to weather and planting. Here on Thursday, April 10, we'll see the monthly USDA report, which will give us an update on supply and demand numbers. This slide highlights Kansas insurance prices for corn, soybeans, and wheat. We just set corn and soybean projected prices in February. Corn projected prices $4.70, soybean projected prices $10.54. We've been lower since then for the most part. We saw the $5.90 July 2025 insurance price traded above for most of February, and since we've been a little bit lower than that. Using crop insurance as your marketing floor can be a powerful tool in creating a marketing plan. Next, we'll move on to some slides asking the question, is it time to take action? We last had an alert for corn on February 10. There's been minor opportunity since then, but we've mostly been lower with the volatile headlines. When tariff headlines die down, even for a day, here's some of the regular market factors to look at. Short-term technicals are reading about 32% on the confidence gauge. Long-term technicals are reading about 36% on the confidence gauge. These two technical gauges are showing room for upside, yet if fundamentals will help us get there. The U.S. fundamental gauge for carryout-to-use ratio is reading 18%, while the world carryout-to-use ratio gauge is showing 31%. Saying prices with similar fundamental situations in the past have been higher, more or less, for the most part. The dollar index and inflation gauge is showing the impact of a strong dollar and how often we've seen lower prices at this level of financials. An attempt to compile all this information together, and the summary gauge provides about a 52%, meaning the market is probably trading about where it should when accounting for all these factors. These gauges don't know directly that we're in another trade war, though. Moving on to soybeans, we last had an alert for soybeans on February 10. Short-term technicals are at 7% on the gauge. Long-term technicals are at 28% on their gauge. Again, showing room for upside if the fundamentals can help us get there. The U.S. fundamental gauge for carryout-to-use ratio is at 43%, and the world carryout-to-use ratio is at 64%. So in some ways, we're seeing, about where we need to be in terms of fundamentals, according to those two gauges on similar fundamental situations in the past. And then the dollar index and inflation gauge is showing the impact of a strong dollar as well, and how often we've seen lower prices at this level of financials, which is about at 69% of the time. An attempt to compile all this information together in the summary gauge reads at about 47%, meaning the market again is about trading where it should when accounting for all these factors, and we'll see what the USDA report on Thursday adjusts in all these gauges. And finally, we'll look at Kansas City wheat. We last had an alert for Kansas City wheat on March 14. Wheat traded a little higher since then and since fell back below that price. Short-term technicals are reading about 33%. The long-term technicals are around 16%, again on the lower side, leaving room for upside if the fundamentals can get us there. The U.S. fundamental gauge is reading 50%, so exactly half the prices in similar situations over the past 10 years or so were lower and half were higher. whereas the world is showing about 39% of prices were lower in similar world fundamental situations in the last 10 years or so. So about those two saying we're about at the right price, maybe a smidge higher if we want to look at that world number. And the dollar index and inflation gauge, again, showing a higher dollar with an impact, and that we've seen 71% of prices lower just by looking at those numbers. An attempt to put it all together, the summary gauge has a 73%, meaning it thinks that 73% of the time, with maybe a slightly broader net cast over all these similar situations in the past, that prices were lower. So hinting at a small downside direction, but we don't know, it doesn't know that we're in a tariff war, and we've traded in this scenario and we've seen $6 with these fundamentals here over the past few months, and we could see that again. Overall, grains have a lukewarm feeling right now, potentially bouncing around in a range as we trade tariffs. The hope is that the bounce up is high enough here in the near future that some of the gauges get to the green, but it's hard to predict. Make sure to watch your inbox if you're subscribed to Market IQ. If we do bounce higher, we'll make sure to make you aware through market alerts so you don't have to miss an opportunity. Moving on to some cattle indicators, we're seeing 1 out of 3 triggered for both live cattle and feeder cattle based on the very simple factors we look at for each. Cattle's been hit just as hard as other markets, and it's kind of been tough to read lately. They've also had trouble picking out highs, but they're very helpful when the market takes a breather and then returns to those near highs. So trade these markets at your own risk. Also looking at hogs, they've been tricky as the RSI, or relative strength index, has not been quite strong enough to give an overbought signal in recent months to trigger all 3 of these indicators, though we came close. The downtrend in other markets in this current climate has also hit the hog markets. Keep watching these indicators to know when to pay more or less attention to these markets. And then we look at US diesel. Reminder that US diesel follows the USLD New York Hardware Heating Oil Futures and looks for a low price, not a high price, looking for buying opportunities. We had a couple times in early March where we had all 3 indicators triggering. This week diesel fell to multi-year lows and will potentially start triggering here. Moving on, we look at the market alerts, the market alert section of this podcast. Here's the outlook so far that we've done for corn. As a reminder, these are sent whether or not the current price is above or below the crop insurance price. Old crop targets are for your remaining total production after harvest. New crop targets are for your target pre-harvest sales in the upcoming season. Corn is sent out 4 of 20 market alerts thus far for the 2025 crop. Continue to make old crop sales if you have them when we do have alerts, as they often align fairly well. As we zoom into this chart, here's a look at the recent market alerts so far this year, with the last one sent out in February. We hope current and upcoming weather months will provide more opportunity. Looking at soybeans have sent out 6 of 20 market alerts so far. And when we look closer at the soybean chart for market alerts so far this year, the last one we sent in February, and we again hope that the current and upcoming weather months will provide some opportunity again in the markets. Moving on to Kansas City wheat, we've sent out 15 of 20 market alerts so far for the 2025 crop. With less than 2 months to go before harvest, be ready to take action, as we've seen good prices right before harvest at times. So make sure to be ready. And here's the chart for Kansas City wheat. March was the last time we sent it out for a market alert for wheat. Would be nice to get some more opportunities above $6, but we will see. Next up, let's move to the section where we talk about price targets. This is the second Market IQ tool that a marketing plan can be created around. Price targets are not predictions, just an action plan if reached. As we mentioned, the crop insurance price was established at $4.70. We have 5 targets stair-stepped higher for corn. We haven't reached them yet, but we've started adjusting targets to 30 cents above the insurance price based on weighing risk and reward and historical research. You can use this as a marketing plan if you'd like to only improve on the projected insurance price with your insured bushels. Be sure to check out our other videos on our YouTube page for a better explanation of that. Moving on to soybeans, price targets for soybeans. The crop insurance price is $10.54. The first target is at $10.79, which we almost reached in February. We haven't reached any of them yet, so we're starting to adjust targets to 20 cents above the insurance price. Again, based on weighing risk and reward and historical research. And finally, looking at Kansas City wheat price targets, we actually did hit the first two targets for Kansas City wheat in February, which had been adjusted as we move through the 2025 crop season. A total of 20% sold or 10% each was taken then, and the next two targets have been adjusted to 630 as we haven't hit it yet during the growing season. Some of these may seem unattainable. It utilizes crop insurance as a floor for your insured bushels and tries to improve on that floor. If we don't get all the targets sold, the crop insurance price is a minimum revenue at harvest to fall back on. Step one for grains is to get back above the projected insurance price. Lots of planting and growing season left for price volatility in corn and beans, and wheat will enter another critical stage soon as we start finishing the production off heading into June. Now we'll move on to some historical price ranges with the current fundamental and technical situations. Reminder that past performance is not indicative of future results. This chart shows today's price versus relatable report date prices. Today's price is the blue line. The yellow dots and lines are relatable report date charts over the last 10 years. The red, yellow, and blue coloring in the background tell you how many times we saw prices at that price range. Red is frequent, yellow is somewhat frequent, and blue is less frequent. What looks like a common price range? Well, just briefly glancing at each chart, the most common range for corn seems to be between $4.50 and $5, though occurrences are limited. So take this one with a grain of salt. Moving on to soybeans, we have a lot more occurrences. Soybeans often trade between $8.50 and $10.75, with a lot of prices happening more in the middle of those ranges. Today, we're trading just below $10, where one of the hot spots are on the chart. Once again, we've got an upcoming monthly USDA report on Thursday, and comparable situations could change. So I found this one particularly enlightening, as we can see where we've been in the past. Wheat shows prices anywhere from $4.50 to $6.50, as frequent over the last 10 years with similar fundamental situations. Today's price, we're trading at $5.75 or so, right on that bottom edge of that mostly frequent traded price. $5.75 to $6 is the most common, and we're on the lower end of that, as I mentioned. In this section, we highlight one area of the Market IQ newsletter or Market IQ app to help keep your understanding fresh and potentially have you find something new. Today, we'll highlight the Market IQ visual. We recently added these basic donut charts to show how many alerts we've sent out. To find these charts, go to the Market News section of the app, then click on the crop that you are interested in. Here you can find these donut charts. The goal for old crop market alerts is to send out 10 market alerts. That equates to 10% each on the chart. The goal for new crop market alerts is to send out 20 of those. Determine your target pre-harvest bushel amount, and that'll equate to 5% of that amount on each chart. Moving on, here's a quick rundown of what Mo is offering for on-farm bids, picked up your farm, or delivered. So we're looking at a 20 under basis, picked up your farm for May corn. For May soybeans, we haven't had a most recent bid at this time of recording. And then for July wheat, we've got a 13 under delivered bid. So be sure to call our office if you're looking to move some bushels, and prices are subject to change. Lastly, I wanted to mention another service we offer that is very relevant in today's climate: managed futures. What are managed futures? A different form of investment with the following characteristics. Diverse investment classes. Managed futures is an investment class that may provide the opportunity for diversification not typically available in traditional stock and bond portfolios, and used by investors seeking to diversify their portfolios for more than 30 years. This includes metals, agriculture, stocks, energies, softs, currencies, livestock, etc. Investment correlation. Managed futures have a low correlation to the S&P 500 TR index and the bond index, based on Barclays U.S. Aggregate Bond Index. Professional money managers. The managed futures industry is comprised of professional money managers known as commodity trading advisors, or CTAs, who trade on behalf of investors using their own unique trading system, usually through analysis of fundamental or technical factors. This provides an opportunity for profit potential, the opportunity to profit in both rising and falling markets. Now, looking at today's market and headlines, there's a lot of uncertainty and volatility in these markets. Most investment funds only have an opportunity to profit in rising markets. Managed futures, on the other hand, have the opportunity to profit in both rising and falling markets. Call us with questions and sign up today. See our contact info in the description below the video. And with that, that's all we have for today. I want to thank you for listening. Be sure to find us on our website or on social media. Contact us for any questions about anything we mentioned today, or if you're interested in any of our services. We'll see you next week.